Hey all, welcome to ShareTreck. This is Raj here. Friends, as suspected, treasury yields are putting pressure on stocks again. And I want to take you across to S&P 500 chart. And this is something we can observe here. I'll just draw it out for you so that you can see. This is the shoulder, this is the head, and this is the next shoulder. However, this is not yet completed. We have been left with a suspense. I would say that this red line which I have plotted out here, which is at the bottom of this gap down that we had, gap up that we had, I think that should be breached on the way down so that we can say that the head and shoulder has been triggered. So if the head and shoulder gets triggered, then we are looking at a drop in S&P 500 of approximately, let me clone this, change the color and pull it down. So we are looking at a target of around 5,569. Right now we are at 5,868, so around $300, $300 drop out there. And I think if we were to plot some more resistances in between or supports in between, that will give us a little bit of more granularity on the descent that is going to happen. Let me take a box. Rectangle. I think I'd like to draw the rectangle out here. I'll dispense with this and just look at this one out here. I'll just pull it up to touch that. Yeah, so this I think is a support zone. If we breach this support zone, then we have another support out here. Let me draw a line out here to show the support. This would be another support for us. I'm going to mark it green. I'm going to make it a little thicker so that you can see it on your screen. And this line also, I'm going to make it a little thicker so that you can see it on your screen. So this is the support that we have to breach first. And we have bounced off it. So tomorrow I'll be very keen to see what happens. And if we come down from there, it doesn't mean everything is bad. It means that we still have a huge area of support which we have to break through. If we break through that area of support, then I think the next stop is going to be at 5,669.58 or approximately in that vicinity. That's what I am thinking is going to happen. And also I'd like to draw your attention to what we have here. If you look at the amount of breadth of spread that support that we have for the stock market rally, it's getting weaker. Our list of S&P 500 stocks above 20-day average has remained very low. It's around 10.93. And if you were to look at those companies which are above their 50-day average, they have also dropped, and they have dropped to a new low of 17.89. And the ones that are above their 200-day average, they have also been very low. They have dropped significantly, and right now they are at 53.28. So I would venture to say that a bunch of companies like the Mag 6 and some AI and tech companies are propelling the S&P 500 ahead. If you take them off and look at the rest of the S&P 500, I think they have been up only 10% overall. So we should make sure that we don't allow all these things to distract us. And we also can look at the bond yields, and you would see that our 10-year yield is at 4.563, and our 2-year yield is at 4.244. So these are all levels which we have to keep in mind, because we have regional banks as well. Regional banks will suffer a lot as yields keep on going up, because the bonds that they have in their balance sheet are going to lose value. The face value is going to be remaining the same, but their market value will go down. And this is what brought down SVB. And what happens is that if the bank's balance sheet starts looking weak because the market value of the bonds that they hold has dropped, then the customers could decide that they want all their money at once. However, if customers don't demand money from the bank at once, then the bank can wait for maturity and get its money back. However, when it comes to banking sector, it's all based on confidence. And if customers lose confidence in a bank, then they do a run on the bank by demanding their money right away. And the bank is forced to sell those bonds at market price and thereby realize losses which are just on the books. So that is the big risk that we see here. And the risk could also spread to credit card delinquency, mortgage delinquency, all those things. So one has to be careful. Today, I think, is a cautionary tale. Today was a very strong reminder to us that the market may go up, but it can equally come down. So we are forming new lower highs. So that is another factor that I'm worried about. And then we have got a lot of new lower lows. We have not formed any higher low as yet. So things are not looking that great. It can change on a dime tomorrow, but looking at what's in store for us in the next 3 to 4 weeks, including Fed Chair Powell going to speak, and the economic data that will come out, Trump taking office, getting inaugurated, and as soon as he's inaugurated, he's going to do a few things that he has promised. How is that going to impact the US dollar? How is that going to impact the yields? And therefore the stock market? That is the big question, and it's not at all clear right now. It's very difficult to see past the next 4 weeks. So we should be patient. We should look at what is happening. We should be calibrated with our risk. At least that's my personal opinion. And I would like to hear from you guys. What do you think? And please put that in the comment section so that I can understand where you're coming from. It will inform me as I continue to plan for the next few sessions. Thanks and have a great day. Bye for now.